Hello guys and welcome again to my channel. So these are the writings in our past video where um, what we did is the step 1 of the accounting cycle or the accounting process, which is the identification of transactions. And as a matter of review, let me tell you again that identification of transactions is the phase wherein you separate the accountable transactions from the non-accountable transactions. Okay? And then accountable transactions are those transactions that can affect this equation: assets equals liabilities plus capital. Okay? Now, as you can see here, I have written debit, credit, and credit. You will know in a little while why is that. So, in this particular video, what we're going to talk about is the recording of transactions, or what do we call as journalizing. So, we will try to record or journalize these transactions. Okay? Now, before we go to the journalizing part or journalizing proper, I have to let you know that you have to have two skill sets in order to understand journalizing or recording. Okay? So the first skill set is determination of what is the meaning of debits and credits. Okay? Now, in order to understand simply debits and credits, you have to think that this is just a technical term for us accountants or bookkeepers. Okay? So technical terms are not new. Actually, there are technical terms for different professions. Like for example, there are medical terms that we don't understand and it's used by medical practitioners, right? And there are also terms that is used by IT professionals that we don't understand. So think of this debit and credit as our technical terms. Okay? Now, basically, simply, this debit is assigned to assets. That is the normal balance of the asset. The credit is the normal balance of liabilities. And the credit is the normal balance for the capital account. Okay? So, what does it mean? The normal balance. It means that instead of saying that the assets increased, you will say the assets are debited. Okay? That's the meaning of it. That's why the assets are assigned with the debit. So, for example, in transaction letter A, in the first transaction, the owner invested 100,000 to open the business. As you can see, the assets increased. But instead of saying the assets is increased because of the owner's investment of 100,000, you say the assets is debited. Okay? Of course, since there is also a credit, even if the normal balance of the assets is debit, sometimes these assets are decreased. So you cannot use debit because debit means increase of assets. Okay? So what will happen? You use credit whenever there is a decrease on the assets. So that's the meaning of that. Okay? Now, on the opposite side, after this equality symbol, we have liabilities and capital. So they have opposite rules with the asset. Okay? Now, in liabilities and capital, when they increase, of course, you will use this credit. So meaning, for example, we have here the supplies, which was purchased 20,000, 10,000 was paid in advance, and the rest were paid after 2 months, right? So that is in transaction letter D. So in this transaction letter D, you can say that the assets is debited by 20,000 because of acquiring supplies. And it has been credited also, the assets has been credited by 10,000 because there is a decrease in assets by way of cash because you purchased this 20,000. Okay? And then, since there is a liability here which increased, okay? So instead of saying that the liabilities increased, you will say the liabilities are credited. Do you follow? So that is the meaning of that. And as you can see, again, debit 20,000 for the supplies, credit 10,000 for the cash that was given up in order to get the supplies, and then another credit to the liabilities for the obligation that you are going to pay after 2 months. So as you can see, 20,000 debit, 10,000 credit in cash, and 10,000 credit in liabilities. So overall, there is a 20,000 credit also. That is what do we call as balanced. So the debits and credits should always be balanced. So the debits and the credits should always be balanced. So that's debit and credit. Okay? Second, on the capital, as I have said, in the capital there are additional investments or investments from the owner, just like in this transaction letter A. As you can see, it was added, so we can say that there is a capital credit. Okay? So whenever there is an additional investment, normally the capital is credited. Okay? So we're getting used to that. We're not saying that the capital is increased. Instead, we will say that the capital will be credited. Okay? Now, as I have mentioned, there are a lot of things that will affect the capital. Like, for example, the withdrawal. So the withdrawal is when the owners get money from the company for personal use. So withdrawals, since it will decrease the capital, the withdrawals has a normal balance of debit because it does not follow the capital. It's opposing the capital. It's a deduction from the capital. So withdrawals has a debit. The revenues, in the other hand, it will increase the capital. So that means revenues has a credit normal balance. So revenues has a credit normal balance. Now, as to expenses, actually, this opposes the revenues, right? Actually, if you're going to be strict about it, the revenues minus expenses are the ones that should be close to the capital. So you should summarize first the revenues and the expenses before you put it here in the capital. So in the next videos, you will see that it's true. But in this particular case, since we are just starting, then you can see that the revenue has been separated. It's not yet combined with the expenses. It's not yet netted with the expenses. Okay? So the expenses being opposite with revenues and being opposite with capital has a normal balance of debit. So again, the normal balances are on the assets, you have debit. So meaning, if the assets increase, instead of saying it increased, you will say it has been debited. Okay? And then on the liabilities, instead of saying that the liabilities increased, you say it has been credited. And on the capital, if ever it will be increased, instead of using the word increased, you say it has been credited. And the withdrawal, since it opposes the capital, it has a debit normal balance. And of course, if there are revenues, it has a credit balance because it complements the capital. It's an addition to the capital account. And of course, the expenses, since that is opposed with revenues, and it is not in conjunction with the capital because you have to deduct it from the capital right here, it has a normal balance of debit. Okay? So that's it for the first skill set. Now, the second skill set is you have to know that there is a chart of accounts. So, chart of accounts. After the debit and credit, you have to know that before you can record any transactions, a company should have this chart of accounts. So, what is the content of that chart of accounts? Before we go to the content of the chart of accounts, let me remind you again that if we talk about assets, that's very generic. So assets are resources, overall resources. But you already know that there are different types of assets a company might have. First of all, there is cash. According to our problem, the cash is usually used. But there are other assets like prepayments, deferred expense, office equipment, supplies. So those assets, if broken down into different items, that will be on the chart of accounts. Okay? So, meaning the chart of accounts starts with, for example, assets. It will start with cash, and then the accounts receivable for those receivables from your customers that you have already done your part. You have already given the services, you have already given the goods. So, accounts receivable. And then sometimes there are marketable securities or very short investments wherein you invest it for a couple of days and you're going to get that investment back for just a couple of days or couple of months, like 2 months, 3 months, and etc. Those are marketable securities, and such investment has already grown. So those are marketable securities. And next will be the inventories. And next will be the supplies. So that will be lined up in the chart of accounts. Cash, AR, inventories, something like that. Sometimes there are marketable securities, as I've said. And next will be the prepayments or deferred expenses. Um, there might be some supplies, and we will go to the non-current assets. The non-current assets are those assets that can be used for more than 1 year or for more than one period. Like for example, we have building, but before building we have machinery, and then building, machinery and equipment, we have building, we have land, something like that. So, chart of accounts is just a list of first, the assets. That's the first one that will be listed. What are the assets? And if you notice, we started with cash because cash is always the first one that will be put right here. And the others, until the prepayments and the supplies, are first. So that is what do we call as current assets. Current assets are those assets in which you can get the benefit immediately within 1 year or less. So, sometimes current assets are also called assets that could be converted into cash within 1 year or less. So, basically, if we're going to have a full definition, simple definition of current assets, this is not technical, this is not based on the conceptual framework of accounting. Okay? So, this is just simple definition of current assets. Okay? So the current assets are those assets in which the benefits will be exhausted within 1 year or less. Okay? And current assets are also those assets that could be converted into cash within 1 year or less. Which explains why the cash is the first one. Because it's already cash. The AR is second sometimes. Sometimes marketable securities is the second because marketable securities are just investments that you can sell immediately and convert back into cash. So marketable securities are most of the time second. And the third one is the accounts receivable because what you need to do in order to convert the accounts receivable to cash is just collect from your customers and so on and so forth. So, after those current assets have been enumerated in the chart of accounts, the next will be the non-current assets. And as I've mentioned, these are assets that can be used for multiple years or multiple periods, like for example, machinery and equipment. So, always and forever, the machinery and equipment sometimes is at the top of the non-current asset versus the building because we are going to list the accounts based on how many years will it be used. Okay? So machinery and equipment are mostly having fewer years of use than building. And of course, the land is the last because the land does not have any lifespan. The land is forever. Okay? So that's the basis of listing accounts in the chart of accounts on the assets. Okay? Now, let's go to the next one. The next one is the list of types of liabilities actually. So if you have liabilities which are to be settled within 1 year or less, that is what we call as current liabilities. So those current liabilities comes first before the non-current liabilities. So those current liabilities example are the accounts payable or your payable to your suppliers, because sometimes those um, items that you have purchased from your suppliers on account has only 30 days credit terms or 1 month credit terms or 2 months only. So that those are current liabilities. If you're going to pay it or settle it within 1 year or less, that's a current liability. Okay? Now, how about non-current liabilities? These non-current liabilities are those liabilities that you have to pay for 3 years, for 4 years, for 5 years. That means those are long-term liabilities. Okay? But there are times that your liabilities are split into current and non-current. Like for example, you have a liability worth 5 million and that you are to pay contractually 1 million each year. So what will happen? So for this year, you have a current liability of 1 million while the 4 million is in the non-current liability section. Okay? So we have loans payable right here, bonds payable, notes payable. As to the current liabilities, the examples are accounts payable, salaries payable, utilities payable, because those are short-term liabilities. So the listing is following also assets and then liabilities, and then we have the capital. Okay? So in the capital, you will have the capital balance, of course. There's not so much with the capital. There are no, what do you call this? There are no items. A lot of items like this, assets and liabilities. There are only few items in the capital. Actually, you just have the capital beginning, and then you will have the withdrawal, and then you will have the net income or net loss, which is the summary already of your revenues minus expenses. Okay? That's it for the capital. Now, next on the chart of accounts list, after the capital related accounts, like again, the capital beginning, and then the withdrawal, and then the net income or the net loss. The next would be the list of revenue accounts. Like for example, a certain company, a multi-purpose company, which offers some service and offers some goods, something like that. They have a lot of revenue streams. Of course, you have to itemize the revenues. They have rent revenue, for example. They have catering revenues. We have gasoline sales. You have to itemize them. Okay? So, that is the next list for the chart of accounts. And we have also different types of expenses, like salaries expense, like utilities expense. So, you have to list them also. So, that is the last. So, if you imagine, the chart of accounts is just a big list, a long list of the different types of assets, starting from the current assets and non-current assets. We have liabilities, which is composing of items of current liabilities and non-current liabilities. And then we have the capital-related accounts. For example, owner's equity, if this is a sole proprietorship, like there is only one owner, and then the withdrawal of that particular owner, and then the net income or net loss if ever, right? However, the net income or net loss does not sometimes listed in the chart of accounts because the revenues are itemized and the expenses are itemized. So the revenue and the expenses, if you are going to summarize them later on, it will become a net income. So sometimes in the chart of accounts, there is no net income or net loss item. Okay? So that's it for the second one. So basically, you are ready to record. But first, let me congratulate you for coming this far. So having the knowledge of the debit and credit, that is just, I think, the gateway to accounting. Because if you already understood what is the meaning of the debit and credit and how to use them, so this is it. This is accounting. Okay? So, I guess I'll be back in a bit. I'm just going to erase this.